Hello, and welcome back to episode 2 of Finance Maths Demystified. In the last episode, we looked right here at expected returns and explained that in quite a lot of detail. And in this episode, we're going to be looking at another type 1 topic, volatility. Now, volatility is dependent on standard deviation and leads into the concept of covariance, but don't worry, I know episode 1 was expected returns. We're going to cover standard deviation in this lesson and move on to covariance next. And then with expected returns, volatility covered, then covariance, we can begin to understand mathematical diversification of portfolios. And then all of this together will lead us into concepts such as the Sharpe ratio and the efficient frontier. So that's what's coming up next. But for today, let's get straight into volatility. So volatility, no bells and whistles. I've just taken a definition straight from Investopedia, which is a great resource, by the way. I'll leave a link in the description. Volatility is a statistical measure of the dispersion, which is basically just another name for the spread apart of returns for a given security or market index. In most cases, the higher the volatility, the riskier the security. Volatility is often measured from either the standard deviation or variance between returns from the same security or market index. It's a good definition. There's a couple things to unpack there. So I already mentioned dispersion of returns. That's the spread of returns around what you would expect or the average, right? And in most cases, the higher the volatility, the riskier the security. There's a bit of a misconception that volatility and risk are the same thing. It's not quite true, but volatility can be used as a measure of risk. And volatility is measured from standard deviation or variance. That's true. Normally, volatility is expressed as the standard deviation, but in mathematical work, variance is often used for calculations, and we'll touch on that a little bit later on. And finally, this variance between returns from the same security or market index. So that means not just the variance or standard deviation of a single asset, but actually the variance between multiple assets within a portfolio. This is already hinting that volatility is linked to a future concept called covariance that we'll come on to. But for now, we're just going to tackle volatility, standard deviation, and variance. So standard deviation, a measure of volatility. How do we begin to understand this? Well, let's look visually before we dive into anything mathematical or examples. So the way I want to do this is looking at a process called a random walk, and we'll look at standard deviation in this context. So what is a random walk? A random walk is when you have some start value, okay? And from this start value, we're going to step along in time. Now, each time we take a step in time, we're going to do something to the start value to get our next value. We're either going to add a number or multiply by a number, and we'll just repeat that process again and again. So once we get to our new location, we repeat the process for the location after and the location after. As we do this, the choice of value that we're going to use to alter our current value could be binary, such as just moving up or down by a value of 1, could be drawn from a normal distribution, and we've not covered this in an episode yet, but think of this as we're starting here. We could either go up 1 and along, down 1 and along, or along and anywhere on a spectrum in between, okay? And we just repeat that process again and again and again. We could add, we could multiply, we could do anything. But the important part of a random walk is that when we calculate the new value, right, it's only dependent on the previous value in the chain, not the historic context. So if you're making a random walk and you end up taking a step up and a step up and a step up, that doesn't make it more likely that your next step will be up. It could still be just as likely up or down, right? There's no sort of gambler's fallacy going on here. It really is random. Past performance doesn't indicate the future trajectory of this kind of model. So an additive random walk, what is this? It's a type of random walk, and at each step, we're adding on to the current value, so not multiplying. In the context of stock prices, what this means is basically the price change is independent of the current price level. So a bit technical. What does that mean? Well, if we're adding on to the current price, right, and our choice is random, let's say we're adding or subtracting 1, right? If the stock price is 100 and we're adding or subtracting 1, we're moving by 1%. And if the stock price is 10 and we're adding and moving by 1, the price is changing by, well, 10%, right? So in other words, the value that we are moving by is not relative to the price of the stock. A stock being at a higher price does not mean we're making a larger jump up or down, and having a smaller price doesn't mean we're making a smaller jump up or down. It's a constant each time, right? So that's what that means. And like I mentioned, it's not dependent on the previous movements or historic movements of the stock price. So here I've got an image of what this random walk looks like. These three images show different standard deviations used in this random walk. On the left is a low standard deviation of 0.02, which is low volatility, all the way over to the right, which is a standard deviation of 0.1 or a high volatility. Okay, so what are you looking at? If we do a single random walk, we begin over here and we take our random steps up and down and up and down and up and down, and we trace out a price movement line, right? Now, if we randomly simulate on the computer thousands of these movements, thousands of these lines, and overlay them all on the same image, this is what we get here. So this shows at a glance all of the possible movements that this price could take from a starting location. And you can already intuitively see, depending on the standard deviation or the volatility, the lower it is, the less spread we get between the possible maximum and minimum ending value of that price line, right? And the larger the volatility, the larger that spread is, the larger the dispersion, to bring it back to that Investopedia definition. So in this simulation, we can see the theoretical mean here, the blue line of where our stock price is moving, or our variable average is moving. And everything within plus or minus 1 standard deviation is shaded in this red color here. It's difficult to see in this one because the lines are so concentrated, right? But these bands, these standard deviation bands that I've drawn in, they spread out symmetrically up and down over time. And I've also shown that the amount of points or portfolios or possible projections of this asset price that fall within this symmetrical standard deviation band is roughly in accordance with the 68% rule, which we'll come on to later, of a normal distribution, which basically says for a random variable, you would expect 68% of the values in that data to fall within 1 standard deviation of the mean. In a sense, that is a definition of standard deviation with respect to normal distributions, right? Geometric random walk. This is the one that's actually a little bit closer to real stock movements. So in this one, it's multiplicative, not additive. It's a type of random walk where the change at each step is a multiplication by a growth factor, okay? The same sort of growth factors we talked about in the expected returns video. This is more suitable for modeling stock prices, right? This means that the current change is proportional to the current price, right? So if we had 100 as the value of a stock price, right, we're more likely to jump minus 10 or plus 10 compared to if the stock price was 10, we're more likely to jump minus 1 or plus 1, okay? So in the geometric random walk, this is what the results look like. You'll notice it's not symmetrical. This red flaring standard deviation band, this range, right, it grows upwards quicker than it grows downwards below this mean line, okay? Why is that? Well, it's because growth factor has always... Why is this? Okay, let's bring it back to the real world stock prices, right? A stock price can increase or decrease by a certain percentage, right? Which means that even if it keeps on decreasing by some random percentage every step in time, the stock price is never going to go below 0, right? You'll always, lose 10% value and then lose 10% value and lose another 10% and another 10%, but you're never going to become negative. You're never getting a negative stock price. And that's exactly the kind of behavior that's captured in this geometric random walk. And that's why this standard deviation band behaves this way. It's also why we get these much more extreme positive values in the geometric random walk compared to the additive random walk, because it's multiplicative. When we get successive strings of positive percentage growth, we get compounding effects in the same way that we get compounding on the stock market, right? So I looked again at the amount of values that fall within this standard deviation band, and yeah, again, they roughly align with the 68% rule. So that's quite useful. This 68% rule is going to become important later on. It's something we really want to commit to memory. It helps us rationalize and reason a lot about the movement of stocks and assets on the market, okay? Okay, thanks for watching. That's it for this part. This is going to be split into two videos. The first section here on random walks and understanding standard deviation in relation to these random walks visually. The third installment of this series, the next part of volatility, is going to be looking at the actual calculations and more in depth at the relationship that volatility has with risk. So hope you enjoyed and see you next time. Bye.